We have two kinds of receivables. We have accounts receivables and notes receivable. What makes it different is accounts receivable, there's no interest charged if you pay it on time. In fact, we often have discounts to pay on time. So when we talked about the inventory, we had that 310 net 30. We're giving people incentives to at least pay within the 30 days. We're not charging them anything. They're your regular day-to-day bills. Notes receivable, on the other hand, we do charge interest. And we charge what's called simple interest. And the opposite of simple is compound interest. Figure out how much the interest is. There are four components. The principal is the amount of the loan. This is a receivable, i.e. the amount of the IOU, but again, this is they owe us. The interest rate is the percentage charged, and the key here is it's the annual percentage rate. It always has to be annual. You might see APR, and that's because people were confusing customers. You'd get a car loan and they'd say, oh, this is only 1%. And you go, oh, only a 1% loan, and that was 1% per month, which is 12% annually. So people were trying to get things over on customers and having them sign when they didn't know any better. That's why the interest rate always has to be given in annual terms. Even if it's a 1-month loan or a 6-month loan or a 3-year loan, we always give you an annual percentage rate. The maturity date is when it's due. So when do you want payment? Again, we're on the receivable side. So when is it going to get paid to us? Interest is this formula, your rate times your time times your principal. So rate times time times principal. Remember that rate is annual. And so if monthly, your rate's going to be a percentage. Your time is going to normally be the number of months until the maturity date over 12, because it's 12 months. And the book, every now and then, they'll do daily ones where it's a 45-day one, and then you divide by 365. But for any problem I give you, don't forget to divide by that 12. And then your principal is your amount. And remember, a percentage has a point between it. So like 1% equals 0.01. Make sure you put it in your calculator right. On January 1, one of your customer owes you $3,000. Often these will start as an account receivable, and they say, hey, we can't pay you. Let's make that a note receivable instead. And we're going to charge them 10% interest. And even though that's 6 months, we know that's 10% per year, even though that's only a 6-month loan. They're moving it from an account receivable to a notes receivable. So we need to take it out of accounts receivable. We were a furniture person and we knew they were going to do this to start with. This might be sales. But this case, we're going from account receivable to a notes receivable. That would be for the principal amount. So that's $3,000. You always keep your note at that principal amount. Then July comes along, the people pay us. So how much are they going to pay us? They're going to pay us our rate, which is 0.10, okay, 10%, times our time, which is 6/12, times our principal, which is the $3,000. And that's why you always want this at principal, so you can easily figure out your interest. That times that times that is $150. Now, some people like to find out a monthly. If you want it to, you can take the 0.1 times 1/12 times 3,000, and you'll come up with it's $25 a month, and then multiply times the number of months. You end up doing the same thing. When they pay it, I want to get rid of this note receivable. I'll put that at the bottom so that I know I've got enough lines in the right place. I know I'm going to get cash. Cash is going to be the $3,000 plus my interest. The difference has to go here. That's interest. It seemed like we made some money there, right? That's interest revenue. And either spell out revenue or make sure that I know it doesn't look like receivable. That's all there was. It'd be really simple, but of course there's things that make that a little more complicated. We're doing the same thing, but instead I'm going to make the agreement on November 1. This is where it really is a good idea to use your fingers. November to December is 1 month. December 1st to January 1st is 2 months. Here to here is 2 months. And that thing matures in 6 months. So let me go again. So I got November 1 to December 1, December 1 to January 1, January 1 to February 1, February to March, March to April 1, April to May 1. May 1 is when that thing is due. So on November 1, the good thing is nothing new here. Again, this used to be an accounts receivable. I make it a note receivable. Still comes in at the $3,000 principal. Nothing new. Now the problem is 12/31, that's going to be our year end. I've earned some revenue that I haven't booked yet. And that's one of those adjusting entries we did, I don't know, back in chapter 3. I earned some revenue, and that's why I kind of did this little subcalculation up here, where I need my rate of 0.10. I'm going to leave a blank there, times my time times my principal. And my time is 1 to December 1, November to December to the end of December. So I've gone 2 months that I have to record my interest revenue. And that's why if you came up with how much it is per month, sometimes it's a little easier. If I do that calculation, it's $50. On 12/31, notice this is an adjusting journal entry. I need to book some interest. Put this one down here. And this is going to be my revenue because the revenue is a credit. So then I've got this interest, and what is it? Well, the people owe me that interest. They haven't paid it yet, but beyond this $3,000 note receivable, if they would pay January 1st, they'd pay me that extra $50. So it's just another receivable. And that's why you have to make sure I can tell which one's a receivable and which one's a revenue. Good thing is on the computers, you have drop downs, make your life a little easier. Then when they really pay me, life's a little bit more complicated. And there's a couple different ways to do it. I'm going to do it in one journal entry. What has to go away? This note receivable has to go away. So to get rid of the note receivable, I'm going to credit it. So that's got to go away. This interest receivable, it's not receivable anymore, assuming they pay me right. I'm going to have interest receivable. That has to go away for the $50. The cash they're going to give me, is this $31.50, but you can go through this calculation again. I got a little hole here because that thing doesn't balance. I need an extra $100 here. And what should that be? I have 2 of the 6 months in this 50. That means the next 4 months, which would be January, February, March, and all of April. So 4 months, if I can get my fingers in the right place, is going to go here. So it's always a good idea to calculate it just to make sure you don't mess up. So again, our rate times time times principal, and we determined this was 4 out of 12 months. If I wanted to, and this is why this is sometimes easier to do, if I just take it times 1/12, that comes up with 25 per month. I knew 2 months go up here, and I know 4 months go down here. So this is my interest revenue. When your Receivable goes across fiscal years. You have to make sure you get the revenue in the year it's earned, not in the year you collect it. And I'll almost always give you months. Okay. If they have days in there, they'll say something like a 45-day or a 75-day note. You divide by 365. If it's months, you divide by 12. Then, like we did with the accounts receivable, what if the customer just skips town, doesn't pay us? We get to write off that note receivable, or we don't get to, but we have to. We don't have allowances for this. We assume if we give somebody a note, they're going to pay it. What we'll do is if the time goes past, we'll take that note receivable. Again, we got to get rid of that, so that has to go away. And then you have to get rid of all the interest receivable. This has been past May, so I've already booked that whole 150. And then I'm still going to hold out hope that person's going to pay me. So that's what now goes to the new accounts receivable. They owe me now $31.50. Ratios are in each chapter. The first one we want to do is the quick ratio or the acid test ratio. That's the cash, the short term, and the net receivables. It's telling you how liquid you are, how easily you can pay your bills. And so looking up here, I've got cash and cash equivalents. The cash equivalents are if you have some things in real short-term investments. All your cash goes together. You don't care if it's a checking account or actually cash sitting in a drawer. Short-term investments are things you can sell really quickly. So if you had some stocks and bonds, you can sell those really quickly. And then our accounts receivable. Those are the things that we think we can convert to cash fairly quickly, as opposed to, inventory, which might take a little bit longer. So we're going to add those up. So we want to add these three up. That totals up to 92,400. And then we divide by our current liabilities, which normally we'll be giving to you. So our current liabilities are down here. Those are our total current liabilities. 92,400 divided by 122, which is 0.757. This one, there's kind of a benchmark. We usually want this to be about 1. This one, it's a little below 1. We like above better. When I compare that to the current ratio, which we talked about a long time ago, which is also liquidity. And if you remember, that one was just your current assets divided by your current liabilities. Current assets up here are 288. They'll always be more than. They could be equal, but normally more than, because you got inventory. 288, 400, but you still divide by your current liabilities. I want to divide that by 122. I come up with 2.364. If you remember, on your current ratio, you wanted that to be about 2. This is acid test. It is, if we need things quickly, we want to at least be able to cover our current liabilities with our current assets. This, since we include inventory and things that are going to take a little bit longer, this also tells you how liquid you are, but you need a little bit more cushion, because to convert your inventory to cash, you might have to liquidate it. You might have to sell it at a discount. You might just have to wait to collect the cash. The other two we have is a receivables turnover. Turnover is just that. It's how quickly we turn over our receivables. We had inventory turnover in the last chapters, and that's the same thing here, but it's how long does it take us to collect our receivables. We want our net credit sales, and if they just give you sales, just use total sales, but in the perfect world, you use your credit sales. We divide it by, notice we got the word average here. Remember, if we use an income statement account and a balance sheet account, we usually average that balance sheet account. That average is just beginning and end, or this year, prior year, same thing, divide it by 2. So I go up here to my accounts receivable. This is this year. I want to add next year is 134. And you need to divide that by 2, just as if we had somebody was 64 inches tall and another person 70 inches tall. You add them and divide it by the number of people. We'll always have 2 observations. So you divide by 2, you come up with 67,200. Always eyeball this to make sure that this number's in between those 2, because on my calculator, if I type in 64.644 plus 70 divided by 2, I'm going to get a different answer there, because it's going to take the 70 divided by 2 and then add it. So when you mix and match the additions and the divisions, that's when your calculator gets weird on you. So I always add that first. I go ahead and total it and then divide by 2. 67.2 was the magic number. Net credit sales has to be given. 766,500 divided by 67,200. And that gives me 11.406 that you can't see, but I can see it. That means that I collect accounts receivable 11 times through the year, but it really makes more sense if I switch it into days and receivables. There's 365 days in the year. If we turn it over 11 times, I come up with 32 days. On average, my accounts receivable are outstanding for 32 days. If this was 210 net 45, that would be really good, because I'm collecting them faster than my 45 days that I had hoped. If it's 210 net 30, that's still pretty good. I don't have too many lingering out there. That's all there is to receivables. If you have any questions or problems, feel free to call.